Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 34. Following are the details of portfolio consists of three shares A, B and C, and the portfolio weight is given, beta is given, expected return of the portfolio is also given along with the total variance, nothing but the total risk is given for the shares. Now standard deviation of the market portfolio is given, which is 10 percentage. Okay. Now covariance for AB, AC, BC is given. Okay. Now the portfolio beta can be found out directly by weighted average method. So since we have the beta of individual shares, individual beta of the shares multiplied by the portfolio weight, and the summation of that will give us the portfolio beta. So as we can see, 0.2 multiplied by 0.4, then 0.5 multiplied by 0.5, and 0.3 multiplied by 0.10, and the total of these three will give us the portfolio beta, which is 0.66. Okay. Then the second requirement is residual variance of each of the three shares. Now we have the total risk of three shares, and residual variance is nothing but the unsystematic risk. So whatever the variance, residual variance is nothing but the unsystematic risk for the three shares. So we need to find out the systematic risk in whatever is left over. That is what is residual, right? So over and above the systematic risk, whatever is there leftover risk, that is residual risk, and residual variance, which is nothing but the unsystematic risk. To find out that, first we need systematic risk, then we have to reduce it from the total risk to get the unsystematic risk or the residual risk. To find out the systematic risk, the formula will be beta of the respective stock square multiplied by total variance, because beta signifies the stocks sensitivity towards the market return. So the market's risk multiplied by the beta will give us the individual stocks risk. And as we know, variance is already a squared standard deviation, so beta also we have to square it up to get the residual value, and this is the standard formula. So beta square of is A multiplied by the total variance of the market, we have to take so we have the standard deviation of market portfolio return, which is 10 percentage. So the variance will be 10 percentage into 10 percentage, which will give us 1 percentage or 0.01. So that's what they have multiplied with the beta square, so that will give us 0.0016. And this is for share A, and for B it is 0.0025. So 0.5 square multiplied by standard deviation square of market return, 0.01. This is for C, which is nothing but 0.0121. Now residual variance can be easily found out, since we have the total risk already. Total variance minus the systematic risk will give us the unsystematic risk, nothing but the residual variance. So 0.015 minus 0.0016 will be 0.0134, and in case of B it is 0.0225. In case of C it is 0.0879. The third requirement is portfolio variance using Sharpe index model. For that, the specific formula is given, which is nothing but systematic risk plus unsystematic risk will give us the total risk, nothing but portfolio variance. So for systematic risk, it will be variance of market multiplied by the beta portfolio beta squared plus unsystematic risk is nothing but individual variance of the stocks multiplied by the portfolio weight. So that square also, that will give us the portfolio variance using Sharpe index model. Now we have already found out this systematic risk for the second requirement. The same thing we can use. We just need to find out the unsystematic risk portion, and the systematic portion we can directly multiply with the variance. In second requirement we found out individual returns, so that will not be useful, sorry for that. For third requirement we need portfolios systematic risk, so we can directly multiply with the market variance multiplied by portfolio beta the whole square. So we have already found out portfolio beta in first requirement, that multiplied by 0.01 will give us the systematic variance of portfolio that we have already found out. Now as I told, unsystematic risk portion can be found out by individual stocks weight square multiplied by the unsystematic portion, right? Let's say in case of stock A it is 0.134 multiplied by the beta zero point 0.4 square, portfolio weight square of A. Same way 0.025 multiplied by 0.5 square, then 0.0879 multiplied by 0.3 square will give us the unsystematic portion, which is nothing but 0.014072. For this is unsystematic portion of portfolio, and plus systematic portion, if we add up we'll get the total variance. So total portfolio variance using Sharpe model. Now I'll give a derivation of how this formula works. It will be useful. So as we solve in previous problems, if you would have seen my videos, we used to use this A plus B approach for finding out the variance of a portfolio. Now this variance can be systematic also, unsystematic also. We are majorly focusing on unsystematic risk portion. So even if it is for total risk also same formula, or unsystematic risk portion also same formula. But since in case of an unsystematic risk, the correlation between the stock and the market return, or the covariance between the stocks itself will be fully uncorrelated. There will not be any correlation. That's why unsystematic risk will differ from each company. It is company specific. In case of beta, in case of a systematic portion, there will be some correlation between the stocks, but in case of unsystematic risk there will not be any correlation. So the correlation portion of the formula will become zero if, let's say, in case of two securities, a plus b the whole square approach, a square plus b square plus 2ab multiplied by the correlation of a and b. If the correlation is 0, then this 2ab multiplied by 0 will become 0. So it will be just a square plus b square. Hence the formula will become weight of a square multiplied by standard deviation of a square plus weight of b square multiplied by standard deviation of b square, or the variance of b square. Same way the three security approach also, this is for three securities. A plus b plus c the whole square, wherein we do a square plus b square plus c square plus 2ab multiplied by correlation of ab plus 2ac multiplied by correlation of ac plus 2bc multiplied by, sorry, this is not plus, multiplied by correlation of bc. Here also, as I told, in case of unsystematic portion the correlation is 0 because it is fully uncorrelated. If it is correlated, perfectly correlated, then it will be 1, and if it is positively correlated, positive 1, negatively correlated means minus 1, right? If it is uncorrelated, then it is 0. Hence, if it is multiplied by 0, then these portions will become 0. A square plus b square plus c square, nothing but weight square of a multiplied by variance of a plus weight square of b multiplied by variance of b plus weight square multiplied by variance of c. So this is what the unsystematic risk of a portfolio, right? Which is nothing but the the same thing they have done here. If we see the unsystematic variance, they have taken weight square multiplied by variance of a, weight square of b multiplied by variance of b, and the weight square multiplied by variance of c, which is nothing but our a plus b plus c square approach, wherein since because of uncorrelated securities, this portion will become 0 and this formula stands out. So even in case if you forgot, you can just apply this basic logic and then derive at the formulas. Okay, now going to the fourth requirement, portfolio variance on the basis of modern portfolio theory given by Markowitz. This is nothing but our a plus b plus c the whole square approach. You have to just follow this formula. That's it. We have to just apply that weight, this thing, same thing. Since three securities are the same thing, if we follow, we'll get same results. That's it. So the portfolio variance is 0.0363.